All right, so on the ET Money Show, we routinely talk about investing in the equity and debt markets, but there's one more aspect that often stays under the radar, and that is your post-retirement savings. A systematic withdrawal plan, or SWP, is one such saving come investment tool for retirees and senior citizen. In fact, for whoever wants to redeem their investment or want to come out from an investment portfolio or an instrument, SWP is a kind of a tool that you can actually apply to it. Let's welcome on board Harsh Roongta, founder, Fee-Only Investment Advisors, to understand more about systematic withdrawal plans. Hi, good evening, Harsh. Welcome to the show. And let's talk about SWP in detail today, because a lot of questions that come around on this topic. First, help me understand what do you actually mean by systematic withdrawal plan? Because a lot of time we tend to associate this particular feature or tool with retirees and for the benefit of post-retirement. It's more apt there, there's no doubt about it, but it's not that other people who have other type of goals lined up, which is a non-retirement goal, cannot add on this feature in their portfolio if you want to. So what exactly is SWP?
As the name suggests, I think SWP is, from a corpus, you keep withdrawing something on a systematic basis. The reason it is very relevant for senior citizens who are retired is that it enables them, just like a systematic investment plan does rupee cost averaging, a systematic withdrawal plan does the same for withdrawals. And I think that's something on which there is very little focus. If you look at retirement, the whole focus has been on the accumulation phase during the time when you create that corpus. There is very little study on the when you need the money actually for your pension. And, at that time, the variables are so many. What is the amount of corpus you have? What will it earn? How long you will live? What is the amount you can withdraw so that the corpus, lasts for your lifetime? Now, these are four variables, which are, each of them is a separate issue by themselves. And the only product that currently caters to that is the annuity product, the life insurance annuity product, where obviously, given our penchant for having a fixed return, they give a fixed return for as long as you live. They give you a fixed amount for as long as you live. Now, obviously, they are taking all the risks. They are taking the risk for how long you will live, and what the money, what interest rates it will earn. And therefore, obviously, that amount is small. So that's a market that's not hugely developed as of now. The market where, the citizen himself creates a corpus and pays a pension to himself through a systematic withdrawal. Now, not too much study has been done on that. You have some references to the 4% rule that's basically a US-based rule that really has no relevance to India at all. But it is an extremely powerful way in which you can, because people are now living for 30 years, 35 years beyond retirement. So when you live for that long and you will be needing money for that long, you cannot afford to lock in your entire amount in a fixed income, because that will not beat inflation. And you need to beat inflation after taxes. And I think the only product that can do that for you is equity. And how to include that and how to benefit from a a systematic withdrawal strategy is, I think, what we should be discussing today.
So now help me understand. Now you're saying that the annuity market is really not very well developed. Now how can SWP used over here so that the entire phase post-retirement, if you want a regular income, you not only have to, you do not depend on annuity products, but also stay invested in equity or any other asset class, and also get the benefit of SWP. How can we work around this particular strategy, keeping your taxes in mind and keeping the requirement of your regular income in mind? If SWP is an integral role that will help you achieve this stage or the amount you want in your hand, at what age should one apply this? What kind of investment should be going in before you opt for an SWP? I think all these basic information or basic working would be needed if you are thinking of an SWP later on in the post-retirement phase of your life. Harsh.
So I think, as I said, for the first part, there is a lot of work that has been done. We've covered this in many programs on the accumulation phase. Let me today concentrate on the SWP, the Systematic Withdrawal Plan phase, when you actually need the money. And there, a self-balancing balanced fund. And we have done this work. Basically, we picked up data right from 1979. The Sensex data is available. We've picked up fixed income data from 79 to 2005 and extrapolated it into a liquid fund. So effectively, we have data both for fixed income and for equity markets going back from 1979 till 2022. Now, let's say somebody had 1 crore corpus, and how much can he withdraw in the past if he needed to withdraw for 30 years? So that the corpus does not run out during those 30 years. And how do you determine that? So based on past performance, I think what we have determined is that if your corpus is put 80% in the BSE Sensex and 20% in a liquid fund, and now if you go back by past data, if you had started your withdrawals at 20 for a 1 crore corpus, if you started your withdrawals at 27,300 rupees, then in the past for 30, and that 27,300 would keep increasing for inflation. I think that is the issue with annuity. In the annuity market, the amount remains fixed. So while starting, it might be decent amounts. As the years go by, the value of that money reduces. In this, we are assuming that your withdrawal will go up by 6% every year. And this is also after taking into account a 10% capital gains tax. So if withdraw 27,300 in the first year, 29,000 in the second year, 30,700 in the third, and so on. For 30 years, you keep increasing it 6% every year. That 1 crore will last you, has lasted you in the past for the entire 30 years. It didn't run out. Now, if you were to take a little more risk and say that I'm okay if it sort of, runs out 5% of the time, that number, instead of starting at 27,300, that number jumps up to 47,100. So that is the kind of jump. It almost doubles. And that money you can withdraw, and please remember that is also inflation indexed. So that 47,000 will become 50 in the second year, will become 53,000 in the third year, and so on. This is a very powerful strategy to get an inflation indexed pension, because a self-balancing fund is both a tax-friendly measure, because the balancing happens inside the fund, and when you withdraw, only the gains portion is taxed. It is so tax-friendly that it allows you to, withdraw amounts without if you go by past experience, without the fear of running out of corpus. But the disclosure there obviously is that these workings are with a lot of assumptions, and obviously the biggest disclosure there as is required is that past performance does not always repeat in the future.
So, Harsh, the question is, when we are withdrawing the money, the corpus is invested in what kind of a fund or in what kind of an investment instrument? Because it's also growing over there. I mean, it's not that the investment that you've put in is not compounding anymore.
So correct. What this has assumed, as I mentioned, is 80% in a Sensex index fund and 20% in a liquid fund, but in a fund that has this, where it is constantly being kept at that level, at 80 and 20. So say, assume you started out with 1 crore and 80 lakhs was put in BSE Sensex and 20 lakhs in liquid, but in a fund of funds. Okay. So obviously if the Sensex rises, then they would have to sell off the Sensex and buy the liquid. If the Sensex falls, they will have to sell the liquid and buy the Sensex. These all assumptions have been taken in this working on the past data. And after that, these withdrawal assumptions have been taken. So these are based on Sensex data, 80% Sensex, 20% liquid, where they automatically keep rebalancing at every month.
So, obviously, a lot of work before SWP is done, which is in the accumulation phase. Here we are considering post-retirement, but anyone who wants to maybe go for an early retirement phase, maybe want to retire at the age of 40 or 45, you know how the new trend is catching up. People want to retire early and then later on figure out and explore as to what else they can do. And when they are doing that, they might come across any source of income, but then not necessarily they might find one, which also means that the amount they've accumulated needs to last for a longer time. So how can SWP be helpful here for these people who want to go for an early retirement phase?
So SWP may not really help the people who want to retire early, because they would have intermittent incomes. They are not really retired in the sense they are doing what they want to do. They're not working for money. That's my assumption from what you just said. In which case they are not sure how much they would want to withdraw every month. It would depend if there is a shortfall on their income. The normal idea is that the corpus that is accumulated can continue to grow, and their current expenses they will meet out of current incomes. Now they don't need to accumulate more corpus. I think that is the general understanding. So they need to withdraw from the corpus only in case of an emergency, if the current income doesn't come through at all, even equal to the living expenses. So I think those would be case-to-case calculations. So I don't think systematic withdrawal would help those people.
Explain the tax implication involved in SWP, but I would request you to repeat it once again when you are withdrawing the money on regular basis.
Sorry, what was the question?
The tax implications involved.
So when you withdraw on a systematic basis, please remember that installment contains a bit of principal and some amount of capital gains. On the capital gains, okay, if it is long term, then you pay whatever that 20% tax after indexation. And if it is short term, then you pay tax at the normal rate, but only on the gain portion. And when you do systematic withdrawal, most of the installment amount is principal. So the tax is payable on the gains, but it is on a very small portion. I don't think more than this I can explain without drawing it on the board, etc. But I can tell you that the impact of tax is very low, much lower than the rate suggests. So long term, after it becomes long term, it is 20%, but that even that 20% is applied only on the gain portion. So I think the impact of tax is very, very low.
This is why a withdrawal strategy from your investment would be better if you opt for a systematic withdrawal plan. And what would be the nitty-gritties related to that were explained by Harsh Roongta. Harsh, that will be all with you on the discussion today. Thank you so much for being on the show.
Thank you.